instead of diving into some statistics or some math or whatever, because it's a Friday, I thought we'd just take a look at how the market's been doing. This year has been crazy year. Pretty much all years are, if we really get down to it. But so we're just going to see how the market's been doing from a research perspective, kind of like a beefed up research corner. So we have plenty of slides talking about different trends in the market. So yep, let's just get started.
Speaking my language.
The first thing I wanted to touch on was the current definition of low volatility. This is something that we've been touching on in a bunch of our shows over the past few weeks. And so we can touch on it from a research perspective, is that our current definition of implied volatility, our low implied volatility, has evolved. So now, I guess if you would ask people what low implied volatility would be, they would probably say somewhere around like 14 or 15, whatever, something like that. Because if you look from 2020 to 2025, all of the average VIXs have kind of been higher than that. But now, like if you go back to 2013 to 2019, and this is especially something I was talking about with Nick, during that Volpocalypse time where you guys basically had no volatility during that 2017, 2018 period, your low definition of volatility might have been like 11 or 10 or something like that, or like 12 or something super low that we can't even think about right now. So it's just interesting how the changes have been made into the market, how we kind of communicate in the market differently nowadays, where low volatility, high volatility, these are all up to personal preference, and we actually are collecting more premiums than we would have been back in the day. Just a little easier to trade in the market nowadays.
Yeah, definitely a good little point out there, and you're really looking at volatility here, and that's something that I love to look at. You're kind of surprised when you look at volatility. You say it's kind of low right now, but really it's at the higher end of where it's most recently been. Am I reading this correctly, Sahil? Not as high as 2020 and 2022 pandemic years here, but look how mean reverting it was from 20 to 21. So if you're playing a mean reversion here and you've got a 19-ish implied volatility, which is a 1% move in the overall market, the market being such a high price, that makes the move so much more exaggerated, right? So you got to get used to this too.
Yeah.
There's a lot of little factors inside there. So great little slide to put up here.
Well, a couple of things here. I mean, just look at 2015 to 2020, right? And look at 2020 to 2025. And arguably people who have just started trading in these last 5 years have just gotten such an education on volatility and market moves when you look at those numbers right there on FX. And I'll do you one better. I remember when I came into the game in 2006 and I started working at a prop firm, the average volatility, it was pretty low. I mean, it was probably on the order of something like a 27. I don't know remember what it was, probably like 13 or something. I remember volatility popped like 2 points. The whole firm stopped trading because everybody was so short. They made everybody stop trading, and they went into risk management mode just from vol popping from like 13 to 15.
Yeah, right. So just the moves are much higher now. I mean, I put this on specifically for younger traders just like myself, because obviously I've been starting to trade in the past 5 years. So just putting it into a little context, how it was before COVID and how it was after COVID. So
yeah, very good. Good slide, my friend.
Next slide. Yeah. So this one is just something that happened this week. So S&Ps have been hitting all-time highs pretty much every week, it seems like, in September and October. But what's interesting about that is it's been very top-heavy in the reasons why SPX has been hitting all-time highs, and we'll get into that more with the Mag 7 stocks later. But 373 of the stocks in the SPX declined this week, despite the stock market nearing all-time highs. And then in October 29th specifically, 9% of the stocks in the SPX reached their 52-week all-time lows, despite the highs in the market. So it's kind of showing that it's really top heavy, and the stocks are moving, but a majority of the stocks in the bottom portion of the SPX are actually moving down, and it's something really interesting to think about. I would like to point out, so on the table over there, I have the 10 biggest losers in the SPX over the past week, and specifically we can look at Chipotle. Chipotle has really had a drop. I don't know why we were talking about this in the office. It was me, Errol, and Gus yesterday. We were just talking about this in the office about Chipotle being down, just because the CEO has made some pretty interesting comments, the Chipotle CEO, and now nobody seems to be going to Chipotle anymore. It's like $15 a bowl, $14 a bowl of just rice and chicken, burrito, whatever. You can just make it at home kind of thing. So it's interesting to see that.
His comments yesterday were so ridiculous from what I saw. This guy said basically that the 20-somethings that are just coming out of college aren't able to pay for their bowl because of their current situation.
Yeah, student loan debts and everything that they have, credit card debts.
First of all, how about you start getting good like you used to be a long time ago? Like you're not really that good anymore.
Yeah.
I mean, how about just
They
getting
call
the
them
food
slop
hot?
bowls, Chipotle and Kava. Just the white collar workers during their lunchtime go go to these slop bowls. But I mean, it makes sense kind of. It's not as good. You're completely right about that. When these companies start out, when the restaurants start out, they're so much better than when they become so corporatized. So
Exactly.
It's similar about everything, though? I mean,
Yeah.
here at least you can taste it, but that's kind of they lose their innovation, right? And they lose their kind of whatever their intangible is, that intangible thing that makes them good. I would just like to see the food get hot. If I was a CEO, I would make hot food. That's where I would start off with.
Okay, interesting.
Yeah, I'm tired of the Shigella dysentery. Just hot food is what I want.
Yeah, some of these stocks you have on here, Cigna, I noticed that one had a big drop yesterday. I think it was an earnings move. Fiserv, obviously, same deal. I'm actually short some puts in there. It's a tough one. But I think your slide is great here. It speaks to the idea of market breadth recently, and it's been kind of weak. The other thing I'll add is that the thing that I look at a lot, and we have it on the platform, the number of S&P 500 stocks above the 50-day moving average is only it's under 50%. And typically at all-time highs, it's like in the 70% range. So that's kind of interesting to me.
Yeah. So it's all-time highs, but like not how it usually is, which I find it makes for a very weird time trading where you're only looking at a couple stocks basically. So, yeah.
Yeah, you're right about that.
So next slide. So now we can go into the Mag 7. So I'm going to split this off. The way I've split this table off is I've looked at NVIDIA and Microsoft specifically, which are the top two in the Mag 7. Then the rest of the Mag 7, which are the other 5 stocks basically. And then the rest of the S&P 500 stocks, which are the other 495 stocks, or because there's 496 stocks, so there's 503 stocks in the S&P right now. So I've split this off. So January to September 2023, you had 15% of the 15.7% of the contribution to the total S&P was done by 496 stocks. 53.1% was done by 5 of the stocks, and 31.2% was done by just NVIDIA and Microsoft. And so the NVIDIA and Microsoft share has kind of stayed the same, but they've increased their share compared to the Mag 7 because the contribution that the other 5 stocks in the Mag 7 has given to the overall S&P has actually reduced a lot because the bottom stocks have actually increased their contribution a lot. So that's a very complicated way of saying, I have just a one sentence explanation on the right of what I'm trying to say, is the non-Mag 7 stocks have actually increased their contribution share, and NVIDIA and Microsoft have increased their share within the Mag 7. What does this basically mean? Really, the Mag 7 is being led by only 2 stocks, NVIDIA and Microsoft. The other 5 stocks, while they are very important parts of the Mag 7, they have not increased their market capitalization as much as NVIDIA and Microsoft have. And they've really been riding this wave, riding the bubble that people are seeing that we might be entering in the future, which we'll talk about later. So I just thought that was an interesting way of breaking it down between the Mag 7 and the rest of the stocks.
Such a great slide here on showing you that these fringe 500 stocks have really caught up to the Mag 7 or the Mag 2 now, right?
Yeah, basically it's Mag 2 now. Yeah.
Right, as you're pointing out, as opposed to the narrative that everybody talks about, the Mag 7 stocks are really the whole market here. I would actually, just from this slide here, look at it and say, well, if you're bullish, I mean, this is the two-sided coin. If you're bullish, you could be saying, well, this last couple of months, you really got paid on your fringe stocks that you haven't been, getting paid on previously, going back to September 2023. That's the bullish side of it. And maybe that's going to continue. The flip side of that is now you have the overall market, like, the rising tide lifts all ships. Does that mean that we take a little bit of a breather here? Because we don't have any underperformers in the S&P 500 right now. Do you see the two sides I'm trying to make here?
Yeah. I understand completely. Yeah.
What a great slide, Sahil. Really is a great slide. Really kind of gives a lot of good food for thought here. Really a great slide. Good job.
Absolutely. Yeah. All right. Next one then. So now we can talk about market capitalizations. So I have from 2000 to 2025, so 25 years, what the market capitalizations were. Obviously, for the Mag 7 stocks in 2000, and then the other companies had their IPOs later, 2005, 2010, 2012 in the case of Meta. And so this is just how the market capitalizations have risen over time. It's just a nice, interesting graph if anybody was curious. And interesting, in May of 2025, the Microsoft market capitalization was 3.42, and the Nvidia one was 3.30, and they've already increased all the way up to 5 trillion, 4 trillion. Apple has increased to 4 trillion. So just in the span of this year, just in the past 6 months, market capitalizations have increased by like $1.5 trillion or $1 trillion for these stocks. So just shows like the complete rise that is happening. And so I put the Mag 7 stocks, the current market valuations, and their weighting in the S&P 500, just if anybody was curious.
These things are massive, man. They're continuing to roll as markets go higher.
Yep.
Yeah, Microsoft's got to get its act together. I mean, 4 trillion. I mean, we need a couple more $5 trillion companies to really solidify this bull market that we've had.
Absolutely. Just keep on riding the highs. Yeah.
Yeah, hung out here. What's that?
Just keep on riding the highs then.
Yes, of course.
Trade what's in front of you.
Nobody wants the Bears to win ever.
I know.
They'll have their day.
I know. They have their days.
They had a small 2-week period in April this year, but nothing. All right. So next one. So everybody is talking about AI bubble, no AI bubble. I'm going to pose a question to you guys just to get your input on this. Do you guys think we're going to be entering a AI bubble just like we had in the tech world in the early 2000s, or do you think things are priced into the market correctly right now?
Wow. All right, Jamal, I'll let you go first.
Yeah, I bet you will. First, the word bubble, I mean, it implies that, that something's going to pop, right? And there's this, there's not enough actual tangible stuff. And I feel like it's tangible. I mean, we're seeing the results of a lot of AI. You can argue that there's a lot of overspending. I mean, you could argue that part. I don't know if I love the word bubble, but are we a little inflated? Yeah, probably. We could let a little bit of the air out, I would say, of the tire.
I see. Okay. Tony?
I have this argument or discussion with Nick all the time. Everybody says, we're a little bit bubblicious, which, by the way, we should play that little bump that we used to have if we really want to embarrass ourselves. That the market's a little bit bubblicious here, but it's been bubblicious for the last 3 or 4 years. So if we were to, let's just round and say everything's up around 20%. I mean, I know it's close to 15% on average. Some are up a lot more than that in the overall market. I'm talking about the 4 indices like, the NASDAQ, the Russell, the Dow, and the even the S&Ps. If we go down by 10%, is it even a downtick anymore? I mean, the numbers have gotten so big. So what would a bubble, are we going to get cut in half? If we got cut in half, now you're giving me something. You know what I mean? Like that's a market correction. I think the corrections have actually gotten bigger. We haven't had a 5% move, do I say all year? I mean, to the downside? I mean, if it is, it's very short-lived. I mean, we had that one little April, and that was about it. I mean, after that, we haven't had anything of any kind of movement to the downside since April. I think the down move has actually got to become bigger than what everybody's used to. The 10% correction, I think you can double.
So just
those
because
numbers.
the stocks or the overall stock market is higher right now, the prices are higher.
Bigger,
you have to have a
right.
larger percentage in order for a meaningful crash kind of thing to happen. So
That's right.
Yeah.
I mean, my point is we take a 20% move down in the end of this year or January or February, we're back to where we were in 2024 when we were at all-time highs and bubblicious.
Yep. All right. So, I mean, this is kind of what I've been hearing around the office, hearing from a bunch of traders in Discord and our Discord and Reddit that we have now. Just kind of talking about this different things. Some people think we are, some people think it's priced into the market. It's always just good to hear different people's opinions about it. I kind of agree with both of you on that. And just to dive into these tables now. So what are we looking at over here? So we are looking at the top 7 stocks, the tech bubble leaders, I guess you could say, in March of 2000, and then the Magnificent 7 right now in 2024. We only had data up till 2024, so we're going to take a look at that instead. So stuff might be a little bit different right now in 2025, but it shouldn't be too much. So I don't know if you guys remember all the way back in 2000, you had Lucent and Nortel networks. I mean, they don't even exist anymore, and they were the they were 2 of the top 7 back in March of 2000. So obviously 2000 was definitely a tech bubble. What might separate the 2025 version, and the reason people try to bring it up is the market capitalization aggregate for the tech bubble leaders in March of 2000 was 19.0. Right now, the Magnificent Seven is 31.3. So people are saying there's a lot more concentration in just 7 of the stocks. So why are we not entering an AI bubble right now, or why will we? Why won't we? And the arguments to be made against this are the cash reserves, the PE ratio, and the net margin. So the PE ratio for the Mag 7 stocks are actually lower than they were for the 7 stocks. We'll just call them the tech bubble leaders of March in 2000 because there's not really was a name for them. Their margin, so their profit margins are actually much higher. You can even see something like Nortel did not have any profit margin. It was -1. Like when you're not making any profit, obviously there's just a lot of speculation going on. And they have much higher cash reserves. Their cash as a percent of market capitalization is much higher with the Magnificent Seven than the 2000 stocks. So people are saying it's priced in. These tables would suggest that they actually have that. It's not all speculation. There is a lot of speculation obviously going on, but they actually have the cash. They have the PE ratio. They have the profits to kind of back it up more so than the stocks did in 2000. So I don't think, I think a nice takeaway from this is obviously nobody knows what's going to happen in the future. This is true for all of trading, but a potential AI bubble might not happen it might happen, it might not happen, but it won't be as extreme as the tech bubble was in the 2000s for all the reasons I think we mentioned just now. So.
All the way back in 2000, the kid says.
Yeah.
I was in grad school at the time. But you're making my point, and this is a great slide, by the way. You're making my point. Like you said, just looking at that cash percentage and looking at the net margin, very different in 2000 from what it is now. And that's my point. Like we might be a little inflated on the moves, but it's not a bubble, man. I mean, there's tangible value to these companies and assets.
All right, next one. All right, so this is not on Mag 7, this is on Treasury rates. So I found this particularly interesting because obviously, as a younger person looking to do more adult things, hopefully in the future, buying houses, doing more borrowing in the future, Treasury rates and how the FOMC and how the Fed.
Wait. Let's get into the psychological mind of Sahil now. So you said adulting thing. So buying a home is an adulting thing?
Well, yeah. I don't know necessarily how many kids are buying homes, Tony, but
so you don't consider yourself an adult now because you don't have a home?
Oh, is this what we're going for? No. I'm an adult by the U.S. government law saying age 18 is an adult. Yeah, okay. But
really, you can't drink when you're 18. So do.
Oh, okay. So if we're going on that definition, then 21. Okay. If we're going on the maturity of the mind, like your mind only matures when you're 25. No, you can die.
Right? You can go to.
Nah. Adult is when you're not taking money from the parents anymore. That's
okay.
Adult.
So I am not taking money from my parents. I'm on my phone plan with my parents and their healthcare plan because you can be on the healthcare plan till you're 26. And I think that's a good thing to be on my parents' healthcare plan until then. Everything else I'm paying for on my own, okay? Don't let dad confuse you, Tony.
That was the biggest setup, and you are an a-hole. Okay? You're doing that to the kid, right? You
started it. What are you talking about?
You are an a-hole, all right? Listen. You're an adult when you pay for your own phone, Sahil.
Okay, fine. I'm not an adult right now. I apologize. I'm also not looking to buy a home anytime soon either, Tony. So, so my definition still works. Okay.
I think half the office is not an adult. Okay.
Okay.
All right. Whether they own a home or not. All right. When you get off our phone plan is when you're an adult. All right.
All right. I see. I will do that. I promise. Okay.
No. Listen, phone plans are cheap.
Every one of my friends in New Jersey is still living with their parents at home, commuting to New York every single day or working in New Jersey offices, okay? I'm the only one who moved out to another city, okay?
Good on you for doing that.
Or the audience, but I appreciate you playing along.
Okay. It's very nice, Tony. Very nice. Thank you.
You're talking to the dude who moved out at 17.
Your father's going to write me now all day long about this.
Yeah, I know. He's going to take everything I said out of context too, but it's fine. That's his job.
We're going to try to text you. I'm going to text you and call you. Your phone's going to be shut off. My son is a man. You know he takes this stuff real seriously.
Of course he takes this stuff real seriously. Every parent wants their kid to actually, grow up, okay? I don't know if I've grown up in his eyes yet, but
just so you know, Sahil, I never want my kids to grow up ever. Okay.
Okay.
I mean, it's what keeps me relelevant. All right.
Yeah.
Thanks, Tony.
By you not growing up.
Yeah, I know.
So.
You're on the show with Nick, right? You still see him as a kid every time he talks.
It's true.
You're like, man, wow, he's 35. He doesn't know anything though about the market. That's what my dad tells me. It's like you haven't learned anything, have you, in 2 years? Well, of course I have.
I'm just glad Nick wipes his own butt now. I mean, it was touch and go there whether I was going to have to go to college with them. So, you're way ahead of that curve, Sahil.
Okay, thank you. One compliment was received at least.
Oh, this went way off the rails.
Next slide, please, John. Put the slides up.
All right, no, back to the Treasury yields. We segued out of that.
Yeah. Gotta make his point.
So this one's very quick. Okay, so Treasury yields. So I'm looking at 1992 all the way to 2024, and then I just put the Treasury yields this year because obviously you're not basing any of your decisions on what 1992 was. I just put that interesting because it's 4.4% right now, the 10-year. So this is looking at the 10-year Treasury. And during just after the Carter administration, when the into the 80s and then into the 90s, the borrowing costs were just so much higher. And a lot of young people are looking at borrowing costs right now and saying, I mean, they're pretty bad. Obviously, they've been rising since 2020, since COVID, and due to inflation. But the borrowing costs were just so much worse in the 90s, but the home prices were cheaper. So now we have much, much higher home prices, but borrowing costs are still high, but they're much less than they were in the 90s. So I just thought that was something that, as a younger trader, it's just interesting to look at how the Treasury rates were 30 years ago, how they are now. And they've been rising ever since September 24 of last year. And obviously the Fed meeting that happened and Powell's conference that happened this week, he's saying in December we might not even cut interest rates. Like he was kind of hinting at that a little bit. So people are very speculative on Treasury yields right now. So I just thought interesting to put the two graphs on here on the slides right now.
Definitely interesting. So in your humble opinion, when I was paying 18 to 21% to buy my home to become a man,
Here we go.
18 to 21% interest rates to become a man, do you think you have a better point of entry at 4% to become a man? Are you...
Sahil, you don't have to answer that.
It's 5 times easier for you to become a man than it was for me.
We're talking about the interest over here. You're not talking about the principle. The principles are much higher now.
You're not going to win this argument. You're not going to win this argument. Just go to the next slide.
Okay. I'll take Jamal's advice and respectfully invoke the fifth on this one. Okay.
Sure.
All right. These are the currency trends. So we're looking at the Swiss franc, the euro, the Australian dollar, the British pound, the Canadian dollar, and the Japanese yen compared to the US dollar. And according to this graph, the Swiss franc, the euro, and the Australian dollar are trending up. The British pound, the Canadian dollar, and the Japanese yen are trending downwards. Compared to the US dollar, all the world's economies, especially in the West, seem like they're going to shit on all of the countries. So it's nice to see how the countries compare with each other. The Japanese yen has been in the news a lot lately just because of how much it's been falling. So I just put a graph this year. How have all the currency trends been comparing to the US dollar? So I don't know if you guys have any too many thoughts on stuff like this.
We talked about earlier. The central banks obviously had a lot of them had meetings this week, and Japan's doing things different than everybody else. I mean, everybody is 2% for the most part. We're high as 4%, but they're at 0.5%, and they just raised for the first time and only time in 5 years. So.
All right, guys.
Yeah. Yeah.
2 more slides. Stick with me. Just one more slide in the takeaways, okay? So we are trying to, as the research team.
You've done an amazing job. Don't.
Thanks, Tony. I wanted to nice Friday. Nice. Keep it not statistics, not too much math, just general market research talk. I think we should do a little bit more stuff like this on the research team because people have been asking for just general market research. So we're also trying to improve our graphs, by using new stuff, Plotly, on our Python databases and everything. So this is some new code we have written to track stuff that's on the platform directly. This is the most traded stocks this week, the 20 most traded stocks this week on the platform, and how they compare to active trading, your core holdings, your speculative holdings, and your low activity. How that's basically defined is based off of liquidity and implied volatility. If your liquidity and implied volatility is high, that's kind of seen as more active trading. And if your liquidity is low, but the implied volatility is high, that's seen as more of your speculative trading, and then vice versa for the low implied volatility ones. So if anybody was curious what people are trading the most, what are the 20 most liquid stocks on the tastytrade platform, I mean, they're kind of names that you would expect. because they're all in the tech industry, and they're all dealing with different industries that are in the news a lot lately. But these are your 20, and I think we can do a lot more research on stuff that's happening actually in the market currently, what people are trading, what people are actually doing, all the speculations that are happening. This is something we can focus on more on the research team. So if anybody wants to email research@tastylive.com, anything they want to look at immediately currently in the market, we can get right on that. So
I love it. I love it. I agree with you too, by the way. I think you should do a lot more of this.
Yeah, I mean, these are the liquid names. This is where you want to be.
Yep.
So last slide, takeaways. So it's kind of hard to do takeaways for talking about so much stuff that we did today. So I just kind of kept it general to 4 bullet points, which is that inflation easing and rate cut hopes are supporting equities, which is why equities have increased their market share a lot, as we talked about on that one slide, compared to how they were in 2023. Earnings remain strong, but market leadership and valuations are narrow. Geopolitical and policy risks continue to pose volatility threats. Lots of moves when the market is so big like this. The moves that do happen, they might not be as big percentage-wise, but the moves are happening a lot more nowadays with the volatility, and the market sentiment remains optimistically bullish overall. So obviously everybody has their own opinion on what the market is doing. Some are bearish, some are bullish, like we've been talking about. The current SIBO equity put-call ratio is 0.44. When the put-call ratio is that low, it generally means that the market sentiment is bullish. So that's why we might be trending upwards, and we might be trending upwards for a while. But at the end of the day, nobody knows anything. So let's see how this plays out over the rest of the year. I hope at least one of these charts, some of these tables have been helpful to try to understand how the market's going this year for people. So yeah.